Hey everyone, and welcome. Ever wonder what actually happens to your money when you deposit it in the bank? Spoiler alert, it's not just sitting in a giant vault collecting dust like in the movies. Banks are the hidden engines of our economy. They take your savings, magically multiply it into more money, and keep the whole world spinning. But how do they do it? In this video, we're going to break down the entire banking system step by step. We'll cover everything from simple deposits to complex loans, the magic of how money is created, and even why the whole system nearly collapsed back in 2008. If you re tired of feeling lost when it comes to your finances, do me a favor and hit that like button right now. Subscribe for more money myths busted, and let's dive in. All right, let's start with the absolute basics. Banks essentially have four main jobs that keep money moving through the economy. The first one is probably the one you're most familiar with: deposits. You hand over your cash, and the bank puts it into a savings or checking account. In return, they promise to keep it safe and let you access it whenever you need it. But here's the twist: they don't just hoard all that cash. This brings us to the second core function: loans and credit. You see, that money you deposited? Banks lend most of it out to other people. This could be in the form of mortgages to buy a house, car loans, or credit for businesses to expand. Those borrowers then pay the money back over time, along with interest, which is basically extra cash for the bank. Third, we have payments and transactions. Have you ever swiped a debit card, paid a bill online, or sent money to a friend through an app? Banks are the ones working behind the scenes to make all of that happen. They handle the complex process of clearing checks, wiring funds between accounts, and even managing international money transfers through huge networks like SWIFT. And fourth, for the bigger players, there's investments. Large banks often offer services like managing stocks and bonds or providing financial advice to help people and companies grow their wealth. So, you can think of banks as the ultimate middlemen. They create a vital link between savers like you and spenders who need cash to build homes, start companies, or make big purchases. Without this connection, our economy would grind to a halt pretty quickly. Now, it's important to know that not all banks are created equal. They come in a few different flavors, each with a specific purpose. First up are commercial banks. These are the ones you see on every street corner, like Chase, Bank of America, or Wells Fargo. They are your go-to for everyday banking needs: checking accounts, personal loans, and credit cards. They are for-profit businesses, and their goal is to serve as many customers as possible. Then you have the big boss of all banks, the central bank. In the United States, this is the Federal Reserve, or the Federal. They don't have personal customers like you and me. Instead, their job is to manage the entire country's economy. They control the money supply, set the main interest rates, and can even print new cash to keep things like inflation in check. Think of them as the economy's thermostat, always trying to keep the temperature just right. Next are investment banks, like Goldman Sachs or Morgan Stanley. These banks are in a totally different league. They don't handle your personal savings account. Instead, they help massive corporations raise money by issuing stocks or navigating huge deals like mergers and acquisitions. They make their money from fees and commissions on these gigantic transactions. Finally, we have credit unions. These are a fantastic alternative to commercial banks. They are nonprofit cooperatives owned by their members. That means you. Because of this structure, they often offer lower fees, better interest rates on savings, and a more community-focused, personal level of service. The trade-off is that they usually have fewer branches and ATMs than the big national banks. So, which one is right for you depends entirely on what you're looking for. So how do banks actually make money? They're not charities, after all. They're businesses designed for profit. Their main secret sauce is something called the interest rate spread. It's actually a pretty simple concept. Let's say the bank pays you 1% interest on the money in your savings account. Then, they take that same money and lend it out to someone else as a car loan, charging them 5% interest. That 4% difference between what they pay you and what they charge the borrower, that's pure profit for the bank. On top of that, they also rake in a ton of money from fees. We're talking about overdraft charges, monthly account maintenance fees, fees for wiring money. It all adds up. And let's not forget about investments. Banks often take their extra cash and invest it in things like stocks or bonds to generate even more returns. But the real game changer, the mechanism that allows banks to create money out of thin air, is called fractional reserve banking. It sounds complicated, but here's the gist. Banks are legally required to keep only a small fraction of all customer deposits on hand as reserves. This might be something like 10%. The rest of the money, the other 90%, they can lend out. This creates what's known as the money multiplier effect. Here's a quick example. You deposit $100 into your bank account. The bank keeps $10 as a reserve and lends out the other $90 to someone who wants to buy a new bike. That person pays the bike shop owner, who then deposits that $90 into their own bank. Now, that second bank keeps 10% of that, which is $9, and lends out the remaining $81. Just like that, your initial $100 deposit has led to $171 being lent out into the economy. It's a powerful cycle that fuels economic growth. Now, with all this money being created and moved around, you might be thinking, what's stopping the whole system from spinning out of control? That's where regulation comes in. To prevent total chaos, banks are some of the most heavily regulated businesses in the world. Central banks like the Fed set strict rules about how much money banks must keep in reserve and how much capital they need to hold to avoid making overly risky bets with our money. In the U.S., we have the FDIC, the Federal Deposit Insurance Corporation. This government agency insures your deposits up to $250,000 per person per bank. This was created to restore public trust after the bank failures of the Great Depression, and it's the reason you don't have to worry about losing your life savings if your bank goes under. There are also complex interbank systems that keep everything running smoothly day to day. Clearinghouses, for example, are neutral third parties that settle all the transactions between different banks at the end of each day. And during a financial crisis or a panic, the Fed can act as the lender of last resort, providing emergency loans to banks to prevent a total collapse. It's a globally interconnected system too. That simple Venmo transfer you made to a friend might silently zip through financial networks in multiple countries to get there. But this interconnectedness also carries risks, like massive loan defaults, sudden liquidity crunches where banks run out of cash, or even cyber attacks. That's why global regulations, like the Basel III Accords, are constantly being updated to force banks to hold more financial buffers to withstand the next big shock. The world of banking is also evolving at lightning speed. We're seeing huge modern trends and, with them, new risks. Digital-only banks like Chime and Ally let you handle all your finances through an app, completely skipping the need for physical branches. Financial technology companies, or fintechs, are shaking up the old guard by using AI to offer instant loans and personalized financial advice. And then there's blockchain technology and cryptocurrencies. These are promising to make global money transfers faster and cheaper, with some crypto-friendly banks starting to emerge. Sustainability is another massive trend. We're seeing a rise in green banking, where banks prioritize giving loans for eco-friendly projects and move away from financing fossil fuels. But with all this innovation, the classic risks are still there. There's credit risk, which is the chance that borrowers just stop making their payments. There's liquidity risk, which can lead to bank runs where everyone tries to withdraw their money at once. And there are systemic shocks, like a major recession, that can ripple through the entire financial system. The 2008 financial meltdown was a brutal lesson in what can happen when there's too much risky lending and not enough oversight. We've learned a lot since then, but it pays to stay vigilant. And there you have it. The banking system isn't so mysterious anymore, is it? At its core, it's the glue that holds our entire financial world together. Understanding how it works empowers you to make smarter decisions with your own money. So what's your biggest banking question now? Is it about loans, investing apps, or maybe even crypto? Drop it in the comments below. I'd love to hear from you. If this video cleared things up for you, do me a huge favor and smash that like button, subscribe, and hit the notification bell for our weekly finance breakdowns. I've also linked a free banking checklist PDF for you in the description below. Thanks so much for watching. Now go make your money work harder for you. I'll see you in the next one.